Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of the Federal Bank Limited. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touch-tone phone. Please note this conference is being recorded. Now I'd like to turn the conference over to Mr. Anand Chugh from the Federal Bank Limited. Thank you, and over to you, sir.
Thank you so much. Good afternoon, everyone, and thanks for joining us on this call to discuss our FY23 Q1 numbers. I'm here to officially hand over the baton to Souvik, with whom most of you would have interacted by now, just as you would have had a chance to go through our numbers and investor deck for the quarter gone by. This has been a good quarter for the bank, with everything from NIM to asset quality to cost-to-income ratio to ROA, ROE improving on a sequential basis. We have on the call Shyam, Ashutosh, Shalini, Harsh, Venkat, along with other senior officials of the bank. And without further ado, I would hand over the mic to Shyam for his opening remarks, and we follow this up with the Q&A.
Thank you, everybody, and good afternoon. And thank you, Anand, for a great job and all the best in your new role. And welcome to Souvik as he settles into the new role. Like Anand mentioned, yes, Q1 was good. It was very much along the plans that we laid out for the financial year, and I'm happy that we've made a good start. I do think all of you have had a chance to look at our numbers, so I'll keep it very short and open it up for question and answer. The high points that we sort of wanted to talk about is through all this, the asset quality continues to be strong, and we believe that that momentum will continue through what may look like a tough period even going ahead. Credit growth has started picking up. We did see good growth in Q1, definitely better than many years. Quarter one tends to be sluggish. I'm happy that Q1 this year bucked that trend and started seeing a meaningful growth both sequentially and Y on Y, and it was quite broad-based, as you may have observed. Our liability franchise, continues to be very granular and growing quite well in areas that we want to be focused on, and I'm hopeful that the environment that we are in today is actually advantage Federal in terms of deposit growth. And that sets us apart for the year and the years ahead. Many of the platform enablers we've been putting in, be it some of the new businesses like credit cards, personal loans, microfinance, gold, business banking, commercial vehicle, commercial equipment, have all started seeing traction through the COVID period. Some of you may recall in February of 2020, we held a pretty much almost a full-day conference in Mumbai and shared our plans. And some parts of the last two financial years that had to go on to slightly slower gear given the environment that we were operating. Happy that that period is cleared and all these businesses have come back to trajectory, and particularly microfinance, commercial vehicle, commercial equipment, and credit cards are giving us a good feel about the opportunities ahead. And over the next 2-3 years, those should become a meaningful of the incremental parts of the growth of the bank. For the quarter that went by, you would have seen sequentially revenue grew, so did Y on Y. And these are, the quarter saw no one-offs either on the upside or on the downside. If at all, the treasury and the bond market rates had an impact on treasury to some extent, but equally we benefited to some extent on the employee provisioning cost. So there were no significant upsides or downsides, and we could smooth land the quarter quite well, and happy that we've entered the sixth handle in our net profit, and more importantly our ROA touched 1.1, and this is the third quarter sequentially ROA is trending up, and we hope and are hopeful that head should see this progress. So I won't belabor much on the environment. I'm sure all of us are living through it. I don't have any unique commentary differently from the market gurus who have a better view. I tell myself and the team, let's behave like bumblebees. We don't have to believe that the market is tough and start to hide behind anything. We just have to make sure we flap our wings and we will fly. Now we're well positioned to do that. So I'm going to say that our opening remarks are that we said what at the end of the March quarter, that we do believe this year mid-teens or higher growth is possible. and we will course along to make sure that our ROA commitments are honored and our credit quality remains as strong as it always has been, and liability growth will be pretty granular in nature. And of course, fee income trajectory is strong. So barring anything like a treasury gain or a treasury loss, which has not much that you and I can do, we are on course to making sure that FY23 is along expected lines or hopefully even better. So with that, I'll pause. Once again, thank you very much to everybody and happy to take questions. Like Anand mentioned, our entire senior team is on the call. I'm sure all of them will chip in and share their insights as and when required. So allow me to just open the call, operator, and be happy to take questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star 1 now. We have a first question from the line of Mona Khetan from Dolat Capital. Please go ahead.
Yeah, hi sir, good evening and thanks for taking up my question. And congratulations on a good set of numbers. So I have two questions. Firstly, on the margin front, so with about 90 bits rise in repo rate so far, have the yields for EBLR loans also be raised to that extent? Because on the saving account side, the increase has been much less at about 25 bits.
Yeah, you said two questions. Anything else?
Yeah, the second one was, what's aiding such healthy growth trends in Q1, which is, as you mentioned, a seasonally weak quarter. So your thoughts on the demand scenario and also sustainability of the current growth trends?
Yeah, on the first part, Guna, I think the answer is yes. The rate transmission has happened in terms of that which is linked to repo is transmitted almost the day after the repo increase or whenever also on the next day, T+1. And anything linked to any other benchmark is on reset date automatically happens. So all of the book is getting repriced as and when the reset date happens. And like you pointed out, on the deposit side, we've had a modest increase. So we are now caught up with many other banks which had much higher. We at least matched up with SBI to get to 275 on savings. Otherwise, we haven't increased. And term, we are priced quite competitively. May I request others to go on mute, please? Those who are not speaking, please go on mute. The second part of your question on credit growth, we saw, as we noticed, fairly all-round growth. I think there is an inherent shift to banks as lenders has increased visibly, combined with, I think, the demand for credit based on inflationary requirements and also the fact that maybe large capacity utilization is probably at peak in most instances. I think there's a demand increase of banks, and we are participating more aggressively. Our share gain is visible. Our outreach has improved quite substantially. And I think this trajectory will continue. We are at about 1.2% share of the credit, but on the incremental credit, our share of market is closer to 2%. So I think we will be able to grow this quite meaningfully and thereby achieve or exceed some of our growth aspirations.
Sure, thank you. But just coming back to the first question, so you mentioned that almost the entire 90 bits has been passed on, or the entire thing has been passed on to borrowers. So, is it fair to assume that for a large part of the EBLR book, at least for half a quarter, which is probably 1.5 months, because the rate rise happened post-May, the entire benefit is already reflecting in the margin for Q1?
But 40% of the book will have a 40-day gain, and the rest of the book will be measured across periods in time.
40% of the EBLR book?
40% of the book is linked to repo.
Okay. Sure. Got it. And just one clarification. So there's been some reclassification in loan book between commercial banking, business banking, and retail. What does this reclassification pertain to?
Every year, based on the year, we reset in terms of businesses that move to corporate, commercial, or business banking, depending on ticket size. So some reclassification would have happened within the portfolio. At the beginning of the year, we reset so that the account focus changes.
Sure. Thank you. Thanks a lot.
Can I just comment just to make it clear so that even subsequent questions, if there are on this particular, the EBLR linked book is 48%, 47.9. The fixed is 26%, and MCLR is 17. So that's broadly the distribution.
Thank you. We have next question from the line of Maruk Adajania with Edelweiss. Please go ahead.
Yeah, hello, sir. Congratulations. So my first question is on slippage. So the retail and business banking slippage is higher QOQ. Is there any restructured in ECLGS or earlier restructured accounts that has led to it? What explains the higher QOQ slippage in retail and business banking? That's my first question, sir.
Yeah. Did you have a second one, Maru?
Yes, I do. I just wanted to get your thoughts on this whole PPI ban and how it affects you, positively or negatively. That's my second question.
Sure. So let me go with the retail one. Just for the quarter reported is about 200 odd crores. Normally in the pre-COVID we were running at about 140, 150 depending on the quarter. And we believe that for the quarter that went by and maybe for the next 2 quarters you will see roughly about 20% increase from that 140 base, so closer to 200 crores or 180 crores. Largely because the restructured book, the demand for the restructured portfolio was on the customers to repay, and certainly there is an element of at least between 15 and 18% slippage on the restructured book on retail, and that's where we are seeing it. And it's very much along our guided lines or our expectations and our provisions. If you recall last year when we added up almost 530 crores of provisions, we had done a reasonable amount of restructuring on retail, and we said we are building out for a 20 to 25% slippage on the restructured portfolio and yet keep the 65% coverage. So it's almost to script, and we don't see anything that at this juncture differently from what if anything it may improve. On GECL, thankfully almost nil, and at this point in time it's in lakhs.
Got it, sir. So, sorry.
Go ahead. You want to complete something?
No, sir. Please go ahead. Then I'll.
On PPI, I think, as you probably know, we don't do prepaid cards or anything to do with that. So we see that it may shift to demand to credit cards, and that's an area we are putting a meaningful focus. So I expect credit card to be advantage, and therefore we may have an opportunity.
Got it, sir. So on your repo book, reprices in the month of the increase or after every 3 months?
Repo book is instant, T+1.
Instant. All right. T+1. Okay. That's so helpful. Thank you so much, sir.
Thanks.
Thank you. We have next question from the line of Aditya Jain from Citigroup. Please go ahead.
I just want to confirm, so the EBLR would change on the day of T+1, but individual loans might have their own reset date, which as per regulation could be up to 3 months. Is that understanding right, or are you saying that even the individual loans have T+1 repricing?
And you say individual means retail? Anything that...
Right, individual, I mean any loan as per its own contract might have some reset period. So that reset period itself is 1 day effectively. Is that what you're saying?
Yes, all repo linked are T+1 and anything else is contracted, and the reset is based on the contract.
Got it. Thank you.
Welcome.
If I may add, entire EBLR is not repo linked. There is a T-bill linked also, which has a defined periodicity. So 3 months or annual or whatever it is. That is T-bill linked book. So EBLR has two. One is repo linked, the other one is treasury bill linked.
Right. Got it. Thank you.
Thank you. We have next question from the line of Prashant Kumar from Sunidhi Securities. Please go ahead.
Thanks for the opportunity, sir, and congratulations for the good set of numbers. My question is just on accounting side. On provisioning for the quarter, there is 167 crore approx, and in which loan loss provision is 150 crore, and other standard accounts. So in this quarter, I think so the banks are hit by M2M provision. So where has been shown this?
Venkat, do you want to go?
I'm
I
talking
don't
about
understand.
M2M provision.
Repeat, sorry.
So he's saying where is the M2M provision? Ashutosh, you want to go, please. Ashutosh, I think.
MTM provision is separately taken as a provision on investments, not a loan loss provision. Loan loss provision is 150 crores. Balance amount is, this thing. See, in MTM, that amount itself is very small, and it is netting of your appreciation versus depreciation, which is what is the regulatory direction. So we did not have much of investment-related depreciation because our AFS HFT book was very, very thin.
So it means that M2M provision has not impacted during this quarter, right?
The resultant number, which is marginal.
Okay. And only the treasury income, that is the part of...
income is impacted because in first quarter, as you would be aware, there is a permission, there is a tradition of shifting from HTM to AFS. Intercategory transfer, I would call it, not HTM to AFS. Intercategory transfer is permitted in the beginning of the year. So we have not made any intercategory transfer this year. So our book is, our AFS HFT book is very, very slim.
Okay. Thank you so much, sir. That's it from me.
Thank you. We have next question from the line of Nitin Aggarwal with Motilal Oswal. Please go ahead.
Yeah, hi. Good evening, everyone, and congrats on a steady quarter. My first question is on restructured assets. Like, if you can share some color as to what proportion is now under a moratorium and any color on SMA overdues of these accounts.
I think about 1,300 crores of the restructured book has already been in the demand. Therefore, they are in the...
Sir, may I come in?
Yeah, go ahead, Raj.
43% has emerged out of moratorium. And it is spread across till 2024, it is spread across. In Q4, 1,000 crores have emerged, and coming 3 quarters, it is 700, 300. So that is the split. Okay. So when we say that 25% is like the outlook that we carry on the slippages that can happen from this, it includes non-paying, of course, the non-paying accounts also. And do we, Shyam, do we have a good degree of confidence on these accounts which are under the moratorium?
Yeah, we have to rely on the experience of, say, the last 2 quarters. Roughly, it's been between 10 and 15%. So, at the top end could be 20. That's where the trend lies.
Right. And the other question is on the RWA growth this quarter. If I look at the loan composition, the corporates has gained share marginally, but RWA growth looks to be a tad higher, which is resulting in a tier 1 consumption also of 110 odd basis points. Now that we are looking at a much stronger growth in FY23 versus what we have seen in the prior years, how do you look at this consumption as well as any thoughts around the capital raised out? How do you see that?
On the second part on capital, I'll hold that answer because we will see how the next 2-3 quarters shape up and how the environment is. In terms of capital consumption, this quarter, if you break, you mentioned about 100 odd basis points. About 70 basis points is RWA increase for the credit growth, and there were elements of credit growth which had businesses that are short-term loans to companies which have greater than 10,000 crores borrowings from the market. As you know that the RWA goes up, even for a highly rated company, the RWA goes up to 100%. So to that extent, the increase in RWA is on consequence of this. And in terms of our unsecured growth, particularly credit cards, while balance sheet growth is yet to sort of pick up, we've seen good line extension already happening, and that also consumes capital. So two parts: one, both the credit quality and the credit extension for the segments we want are going well. In terms of how much consumption happens and what we'll be able to add back at the end of financial year, we will see. If we dip below, say, 13.5, we may consider, but at this point in time, it's too premature.
Right. And lastly, just one clarification on the earlier answer that you gave around the loan mix based on how is like the mix of floating loans. So our yield on advances on a sequential basis is pretty sort of static, despite like the T+1 repricing of repo, and we have also grown across segments. So why is that so, and how do you see the repricing playing out in the coming quarters?
It will come through. There are some businesses like Agri where the slippages also means the revenue offset, right? So to that extent, you will see that play through. But over 2 quarters, that should stabilize. And we have guided for somewhere in the 325, 327 NIM, and we think we are at 322. Another 5-7 basis points will happen.
Okay, sure. Thank you, and wish you all the best.
Thank you.
Thank you. We have next question from the line of Kaushik Poddar with KB Capital Markets Private Limited. Please go ahead.
Yeah, Shyam, your advance growth has been good, but deposit growth was not keeping pace. So to that extent, what's your strategy for upping the dividend? Deposit growth. Not dividend. I'm talking deposit growth. Your deposit growth was not keeping pace with your advance growth. So how do you plan to up your deposit growth?
I think currently the deposit growth elements you have to see. We can pay more and grow term. Term is very price elastic. So we are focused on growing the granular retail CASA, which has grown 15% Y-on-Y. And CD ratio being at about 82%, we are reasonably comfortable even if it went up to 84, 85. That said, in Q2, you may see that our deposit rates now for both domestic and NR deposits are in top quartile. So you'll see pick up on deposit. Deposit to some extent is dial up, dial down, depending on how the CD ratio is and what you want to do with growing term. If you notice in FY22 end, consciously we didn't grow term because there was no great point in pricing up and taking term. As we see opportunities, we are doing that. But our more structured CASA is growing quite well, domestic and NR.
No, what you just now said is that you have upped your term deposit rate, is it?
Yeah, in Q2, you may have noticed our term deposit rate is in the top quartile.
Okay. And about the relaxation that RBI has made regarding that FCNR deposit, so do you see some opportunity there also?
Materials, again there we have very, very competitively priced, probably amongst the better banks. And we are 7% of India's non-resident deposit market share. About 10 lakh crores is the deposit share of non-resident deposits. We are about 80,000 crores as Federal Bank. Right, so we are about 7.5%. So if India gets $2 billion, which is what most people believe will come in the next 2-3 months or through the window of this dispensation given, we should get our share or higher.
Okay. And as far as capital raising goes, you are holding it back by another 3 quarters or something. That's what you said?
No, I said there is no plan at this point in time. When people said there is a likelihood of consumption of capital and therefore they need to go to the market, I said we'll wait to see how the year shapes up and then we'll decide timing, opportunity and price. At this juncture, there are no plans.
Okay. And on this ROE, what is your target rate? If I remember correctly, you are aiming for something like 1.25. Is that what you have in mind? And if that be so, when do you plan to reach that?
So we said we will exit FY23 between 110, 115. Happily, we are at 110. And we think we will take that 115. We said exit FY24 will be 125. I think we are on course for that at this point in time, unless something dramatically changes.
Okay. Thank you, Shyam.
Thank you.
Thank you. We have next question from the line of Rakesh Kumar from Systematic Shares. Please go ahead.
Yeah, hi. Hi, sir. Thanks for the opportunity and very good set of numbers. Quite a lot of surprises on treasury operations, though we had close to around 1/5 of investment in AFS and HFT. So this is a quite surprise there. So some queries that I have, firstly related to, the PSLC and like overall PSL shortfall that we have. So, just calculation I did that, what the purchase we have done of the PSLC investment in RIDF and the IBPC that we have on the net basis, in this, for year FY22. That is quite sizable number of the total PSL outstanding. So why that, we have so much of dependence on PSLC?
May I come in, Shyam?
Yeah, please.
See, PSLCs were available at 1 basis point. 0.01%, 1 basis point towards the end of the previous quarter. So I think that's one part. So whatever shortfall was there, we have fully taken care of that. And there is something called, average PSL and all for every quarter and all. So whatever earlier quarter shortfalls were there, those also were taken care of in the March quarter. But we are not into PSLC in this quarter. You would not have seen the same one because it has quick mortality. On 31st March, it all expires, becomes zero. So in this quarter, you would not have seen that.
Sir, I was referring to...
Are you talking of PSLC certificates?
Yeah, so I was talking about, what we have done in FY22, entire FY22 as per the annual report. So, what purchases that we have done. So I was referring to the annual report numbers, not this quarterly number.
That's exactly what Ashutosh said.
Yeah, that's what I was telling about the FY22. FY22, we had a shortfall, cumulative shortfall going on for the first 3 quarters. In fact, most of it was H1. The third and fourth, we took care of it, mainly in fourth, by having the PSLCs done. And PSLCs were available at a very, the least possible price, 1 basis point. That's the least. You don't have a price below that. So it was a good economics also to do that.
Got it.
Rather than acquiring portfolios and other things, vis-a-vis the other options, this was the cheapest option available.
So based on the industry weighted average premium, would we have, spent close to 170 crore on the entire year FY22 for PSLC purchases?
I don't think our number is that.
Did you say 170 crore the cost of acquiring PSLC?
Yes, sir. Cost of it.
No, not even a fraction of that.
Not even a fraction of that. That's what
Nowhere close to that, no.
And secondly, sir, in the annual report, we have discussed about expanding our branch network, which has been so far kind of a standstill. So what is the change in the strategy there we have?
For long.
Before that, just complete the question, the earlier question, I just want to add that in this financial year, month on month, we are on target. PSLC, there is no shortfall.
Yeah. So let me just answer the question on branch expansion. For about almost 6 years, we added only 20 branches. And the objective was in my first 5 years, we added almost 750 branches. We wanted to make sure they are all productive and performing. Happy that at the end of March 31, 2022, there was only one loss-making branch in the bank. So that said, we were confident that our traction on leveraging that franchise is working. And we also said we will focus on digital and do digital quite successfully. So while we did that, we said we will move from branch-like distribution heavy to light branch heavy distribution. So light branch means smaller and compact branches in locations where we don't have our flag. So even in Q1, we added 10 branches this financial year. We're committed to adding about 65 branches this financial year, and over the next 3 financial years, including this one, we think we'll add about 200 to 250 branches. And those are very much included in all our guidance in cost, income, non-pro revenues, and plans around that. So we believe that we will create 2-3 more geographies where we are quite potent and dominant.
So we have total return of loans close to around 3,000 crore as on end March, fiscal year end 22. So what kind of recovery that we are expecting for this year, FY23? We did very well in previous year. So any guidance, on that front?
I'm not calling anything specifically out of that, Chief. Our overall credit costs factor in the ins and outs. But yeah, there are opportunities. But that said, the bulkier opportunities, we may not be the primary lender or the only lender. Our strength is when we are one or the main lender, then we have opportunities too. When it's part of a consortium, part of a much larger platform, then there are too many elements to play and legal processes take endless time. So I'm not in a position, but we made full provisions, so therefore those should end up being gained even when they come.
So just one last question. There is a government security, the non-SLR, portfolio. So what is the characteristic of that non-SLR government securities?
Ashutosh, you want to go?
Yes. See, there are certain, bonds which are issued by government, but they are not SLR securities. I'll give you one example. These are, when this SEB restructuring was done, you had these state government bonds issued, but these state government bonds, in lieu of the liability of SEBs, these bonds were not given SLR status. Similarly, whether it was oil, bonds given to oil marketing companies, bonds given to banks for recapitalization, these are all central government securities, but these do not have the SLR status.
Got it. Thanks a lot for taking my questions. Thank you and all the best.
Thank you. We have next question from the line of Pranab from Rare Enterprises. Please go ahead.
Hi, thanks a lot for the opportunity. Sir, I have 3 questions. First of all, the loan growth was very good, and can you just elaborate factors that are leading to it and sustainability of the same? Second is in terms of slippages. So as you mentioned that there will be some slippages uptick because of restructured book. So this will continue. This is happening in both retail and other categories of restructured. And is there any other, something like inflation or economic slowdown leading to retail restructured book? That is second question. And third question is, sir, how you are looking at now employee expenses, because you have given guidance, I think, of 200 basis points of cost to income improvement. So how are you looking at employee productivity going forward, and how are you measuring it, tracking it? Thanks.
Credit growth, I mentioned the outlook is quite positive at this juncture. We grew sequentially at a rate of about 18%, and that should be our run rate for FY23. There are some businesses that may do 25, some businesses may be 12 and 14. So blended will be about 18% growth, which we are confident will happen. Don't hold me to 18, it could be 16.5, 17.5, 18.5, 19.5, but that's the zone. And that's what we're working on. And it's broad-based, it's not just one business. The second question was around,
Retail slippages.
Retail slippages. Yeah, I did mention that I think the best way to look at us is financial year 21, financial year 22, and I said this in the March call also. Our overall slippages for the year were about 1,800 crores, both the years. And I also said I think FY23 will mirror that. And if you saw Q1 was about 444 crores, that's exactly on course to where it is. Now, within the quarter, within the product, there will be some mix up and down, but I don't see it be wildly varying. Thankfully, our corporate book is holding very well. For many quarters, it had nothing in the SMA book, so that will continue. Commercial banking, business banking tend to be, sometimes you have one account of 30 crores, the next quarter nothing at all. So between commercial banking and corporate banking, there is not much of a threat on that count. business banking, retail, SME, agri, you will see some impact driven by the COVID restructuring, coming out of COVID restructuring and the current slowdown of the economy in some pockets. But on balance, the numbers that we pointed out look quite possible, and that's how we have given our full year numbers at around 1,800 crores, or plus minus a few crores here there, is the slippages. And our credit cost.
My question is that, is it just restructured book or is it economic slowdown or anything else like inflation?
I think
impacting retail causing this.
Restructuring he took because he saw some stress in the environment, and they were hoping things will work in favor. If the environment continues to be a bit sluggish, their recovery, their ability to repay may take a little longer. But these are secured books, right? Because large part of our retail is home loan or land loan against property. So I won't call out specifically saying recession or slowdown or inflation. Those are already built into the statement that the restructured guy may have challenges. That's why we said roughly between 18-20% or whatever that number is may see slippages in FY23, and that's how this number of giving the full year slippage guidance is. Within quarters, it may swing a little bit here there. Q1 was 200 crores retail, Q2 may be less, Q3 may be a little more. So order of magnitude won't change materially. And these are largely secured books.
Just to supplement that, I think there may be, because of the need for restructuring and all that, if the probability of default there could be 10 to 15% or whatever it is, because this is yet to be tested also. The loss given default here is going to be very, very low because these are all mortgage books,
Right.
And the third employee cost, I think we've always said, we get misunderstood for the fact that as though it's a productivity issue, and I've said this many times, Pranav, it's not a productivity issue, it's the issue of cost that we have to carry for pensioning. And unfortunately, last year there was a family pension for people who are even retired, right? We can't make an old man who's retired to make productive. But that's a cost, the cost of doing business. Thankfully, when yields have, sort of gone up, while Treasury doesn't get the gains, there are some gains that come on the employee cost because the actual pensioning requirement comes down, as you saw that this quarter. So we think we are in the 500 crore employee cost for FY23 first quarter. If yields are in and around this region, somewhere this number. If yields start trending lower, it may go to 530, 540. But we think the full year employee cost will be about 2,100 to 2,200 crores.
Great. Thanks a lot, sir.
You're welcome.
Thank you. We have next question from the line of Abhishek Murarka from HSBC. Please go ahead.
Yeah, good evening and thanks for taking my question. So I just have one question. How much of your deposits are repo linked and what is the repricing timeline there? And also what percentage of your incremental deposit mobilization is typically repo linked? So just wanted to know that. Thanks.
Our savings book is repo linked. Right? Our savings book is repo linked, and we're not obliged to pass on the entire gain as we didn't in the Q1. You would have noticed, it went up from 250 to 275 is our savings rate.
Right.
Repo minus something, that minus is our choice.
Okay, so if just to clarify, if I have a repo linked SA and repo goes up by 40 basis points, it's not necessary that my SA rate will go up by 40 basis points.
No, not because the spread is
not immediately, Mr. Murarka, but only thing is, in case bank revises the spread, which is done by ALCO and all, then the entire thing would not be passed on. If it is not revised by ALCO, that spread is not revised, then entire thing would be passed on because it's repo linked.
Exactly. So that's what I wanted to understand. So if I have a repo linked SA and the repo goes up 40 basis points, then the next day it goes up by 40 basis points until the ALCO comes up with a revised spread.
ALCO meets the same day.
ALCO meets the same day, yeah.
Okay. So they may revise down the spreads. Okay. And have you seen any any revision in those spreads after this 90 bips, cumulative repo hike?
Yeah, that's why our rates are 275. It's gone up from 250 to 275.
Okay, so 20 bips effectively. Okay, got it. Right. Got it. Thank you. That was my question.
Welcome.
Thank you. We have next question from the line of Rinesh Bua with ICICI Securities. Please go ahead.
Yeah, hi sir, and congrats on a great set of numbers. So just two questions. One on the again slippage side. Of around 400 crore of slippages, how much of this has flown from the restructured book?
About 110 crores of the entire 444 is from the restructured portfolio.
Okay. And if I to assume mostly from the retail side, I mean retail restructured book?
Retail business banking, that's the two large ones.
Got it. And sir, second, again on the deposit side, so in our presentation we highlighted that around 4.5 lakh accounts are being opened every month by FI and Jupiter. So on the aggregate basis, what is that run rate of new account opening on the liability side?
Roughly about 12 to 14,000 accounts a day.
12 to 14,000 accounts a day.
Yeah.
Okay. So large chunk of these accounts are opened by FI and Jupiter.
Yeah, this is the two accounts opened by our partners. I mean, then we do about 5,000 accounts every day.
And sir, is this and what is the let's say average balance of accounts opened by fintech partners versus source organically?
Early, but it's lower than our normal balances built on ourselves. These are people who are younger, new to work, new to category. So the balance build will take time. I think the book is about 500 crores now.
Okay. And sir, just last clarification. So on the investment side, so we highlighted that we have not transferred anything from AFS to HTM in Q1. Is that right?
Yes. No transfer.
Right. Other than the regulatory shift which is to be done in case of your PE and venture capital investments or so, which is a very small amount, there you can keep it in HTM only for 3 years. So in 4th year you have to shift it to AFS. So that's a regulatory transfer. Other than that, we have not done any intercategory transfer.
And maybe just again follow up on that. So I was just wondering, despite a sharp increase in the yields, why we have not been impacted on the treasury side? I mean, why it is just 8 crore? Maybe we can take it offline also. But
if you keep your investments in HTM, you are not required to mark to market, number one.
Correct.
And number two, if you are having a very small, say treasury bill, mainly treasury bills and AFS and all that, which are taken at cost, there would be no need for marking to market. There would be no depreciation.
Right. So no, even if I look at the credit substitute portfolio, I think we have roughly 2,000 crore of that portfolio. So there also, I mean, even if you consider, the corporate yields going up, of course, I mean, we would be factoring all these things. So net it is 8 crore and we don't see any further hit, or how one should look at this?
Actually, for your information, that portfolio is appreciated. Had it been Ind AS, we would have booked some appreciation there.
Okay.
Yeah.
Okay, sir. Thank you, sir.
It is always netted off, your appreciated bonds
Yes,
is netted off. That appreciation is netted off against depreciation.
Correct, sir.
Yeah.
So now just wondering why there was no depreciation, but maybe we can just take it offline.
Yeah. Thank you.
Yeah. Thank you, sir.
Thank you. In the interest of time and fairness to all participants, ladies and gentlemen, please restrict 2 questions per participant. We have next question from the line of Jay Mundra with B&K Securities. Please go ahead.
Yeah, hi sir. Congratulations. Sir, during the quarter we had raised card rate of SA by 25 basis point, and the overall cost of deposit is actually down by 8 basis point. Right. So if you can help explain, where did you gain actually?
Go, please.
Sorry, please come again.
So I'm saying, sir, on your SA, the total cost of deposit is down 8 basis point quarter on quarter, whereas we are in general we are in rising rate environment, and you anyway had upped your SA cost by 25 basis point during the quarter. So which area did you actually benefit, which would have offset such increase?
The term deposits which are there for 3 to 5 years, so the higher value so-called deposits and all, they mature and get repriced. So when you have something in 7 series getting matured, if it's a 5-year deposit, you have to carry it because it's a fixed deposit. You have to carry it. So your higher yielding deposits, rather where the cost is higher, when they get repriced, you get the benefit. So right now, this is just a coincidence that it has just stabilized at number one. Number two, the CDs and all, which if you see during the quarter and all that, have also got matured and all. So overall, the impact on that had been, some 5-6 basis points, but that's not going to be the trend. You would see the, cost of deposits moving up in the following quarters. So, let me not give you a picture when the cost of deposits still have scope to fall and on. This is the earlier ones which have longer tenor deposits maturing and getting repriced at a lower rate.
If I can just add to that, this is Shalini here. I think to add, and Ashutosh has summarized it correctly. Normally, when there is an interest rate change, obviously liabilities lag in terms of catching up with the interest rate. As assets, we pass it on, on a repo basis, as we explained earlier. That is one. Two, the savings account rates actually were changed in 2 tranches in May and June. So you've not seen the full impact of that for the quarter because they were changed in May and then in June. And term deposit rates in the month of April until the repo started increasing, we had very strict control on our term deposit rates. So I think it's a combination of all that. There's a lagged impact. Clearly, the forward-looking view will be different because next quarter, for example, we will see the full impact of the savings account interest rates. Term deposit rates have been raised by us, as Shyam alluded to in the earlier part of the call. So this is just a question of, catching up, and it will happen in the coming quarter.
Sure, ma'am. Yeah.
And Jay, this is Venkat here. Just to clarify, I recollect you mentioning cost of deposits, savings going down. Actually, savings has gone up, but the overall cost of deposit has come down 8 bits. Between last quarter to this quarter, the savings has gone up by 12 bits, but the overall is down by 8. That's for the reason which Ashutosh mentioned. Ashutosh and Shalini both mentioned the reasons. Yeah.
Right. Secondly, sir, if you have this, I think the number is very small, but just to get this correct, if you have the bifurcation of MTM hit and TWO recovery, I think both these things are clubbed together so as to arrive at that number. If you have that number, it would be useful.
Which one? Sorry?
The MTM hit during the quarter and TWO recovery. I think both.
In the other income line, is it? You want that?
Yes.
Usually we don't share that, Jay. So, these things tend to be.
Yeah, we just net it off and give the net.
Yeah, it changes every quarter. There is some quarter we have a remarkable gain on one line. So the blended number is a more appropriate number.
Understood. And last thing, sir, from my side, if you have the, ECLGS outstanding or disbursement and any NPA number there. Yeah, thank you.
ECLGS, like I mentioned, is in lakhs. Thankfully, there is nothing to report in terms of the NPA. Outstanding, if I remember right, is about 3,000 crores. Raj, is that number right? 3,000 crores?
Sir, it's 4,000 and odd crores, sir.
Okay.
So this 4,000 is outstanding, right? Not the disbursement.
Yeah, it's outstanding.
This is the balance outstanding, yes.
Sure. Great. Thank you, sir, and all the best.
Thank you.
Question from the line of Mahesh.
Hey, hi. Just one question. The change in lending yields as compared to the sensitivity of the book, I still didn't get the answer that you explained. Why has it been so small despite it being repriced immediately?
You will see in the quarters ahead because there have been ins and outs. We had some higher slippages in retail and agri, which would have there would have been a reversal of interest income on that count, right?
And also this increase, this repo increase has happened over 2 tranches. The second one was only for 22 days, 8th June. And first one happened on 4th May. So the first part, which was 40 basis points, and second one, which was 50 basis points, that happened in the middle of the quarter. First part was 40 basis points, which was available for nearly 2 months. The second one was available only for 22 days.
Okay. And in your assessment, the direction of margin simply because of the change in yields will be a positive one for at least a few quarters, or it reprices much closely given the way you reprice the deposit side?
So I mentioned that our blended margin NIMs, we are looking at 325, 327, which means another 5 to 7 basis points over the coming quarters.
Okay. So you keep despite much probable appreciation of the lending yield, is it?
Yeah, it ins and outs of everything. Book profile, slippages, cost of borrowings, cost of deposits going up. Blended, we think between 5 and 7 basis point improvement in NIMs is what we are working on.
Okay. Sorry, last question, sir. When you speak to your business heads, like let's say in a Harsh or on the retail side, the business environment continues to remain quite positive despite all what we are hearing outside. So the stock market is in a slightly different world right now.
Like I told you at the top of the call, I said we believe in the bumblebee. We shouldn't get too swayed by either great news outside or bad news outside. Just focus on doing the right stuff, things will happen. It's not a profound answer, but it's the truth.
Okay, perfect. Thanks a lot.
Thank you. We have next question from the line of Pritesh Bumb with DAM Capital. Please go ahead.
I just want to check our gold loan yields have been down by 64 basis points quarter-on-quarter. Anything there? Any incremental loans at lower yield? Anything you can give out?
Yeah, we have some attractive entry pricing for loans for short-term tenor, and that is priced more attractively.
So it's like a teaser right now?
It's a teaser with the belief that some of them will roll over, some of them will pay off. But I have to be honest, a larger number of people are paying off.
Okay. And this, how much time this will continue? Any roadmap on that?
I think it goes on this quarter till July or August of this quarter.
Okay. Okay. And then after that, it moves to a normal rate, I will assume.
Yes.
Just to add,
yeah.
Just to add, these are given very selectively, where the LTV is much better. It does attract a lot of new customers. So by part of building a large customer base, so the repeat business comes in. Secondly, there was, as you have seen, many competitive offers by other players we had offered very competitive pricing. So it was to kind of continue and maintain our share. So it was done, but I guess the competitive pressure on NBFC players has increased with increasing interest rates. So we see the pressure easing off over here on margin and yields improving.
But one point to everybody on gold, I do want to state, we should not assume gold equal to what it was 2 years back when it was a high yielding product. It is certainly higher yielding, but no longer in the mid-teens to higher teens. It's comparatively priced. Though thankfully in Q1 of this year some sanity came. It's not as low priced as it is. In Q4 and Q3 of last year, some banks and NBFCs took the market to a very low rate. Maybe other forms of credit were not growing. So gold almost became like a home loan.
Right.
At a market level. Some sanity is coming now.
Sure. Thank you. And second question was on credit substitutes. I think we've seen a sharp rise of 20% quarter-on-quarter. Any strategy there? I thought in an increasing rate environment that anybody will not go on back of credit substitutes. Anything there?
Harsh, you want to add?
Yeah, I will. The credit substitute includes both short-term and long-term. We have largely been at the short end of the curve. So it includes commercial paper. So the increase in pricing is already priced in over there. That's number one. Number two, the strategy, many of the corporates need to tap the debt capital market because that's under the large exposure framework issued by RBI. So under those guidelines, many corporates need to tap the market, and we as a bank want to give entire suite of products, including substitutes. But all these products are priced in as per current levels and never done at the cost of margin.
Sure. And sorry, last question was on personal loans. I think, Shyam, you were mentioning from last quarter that we were slow, we were not pushing personal loans. But do you still see environment a little difficult in terms of not pushing personal loans especially to our ETB customers?
It's beginning to pick up. We did delay the reset of parameters to the erstwhile pre-COVID. In the middle or towards the last month of this quarter, we saw pickup. I think from here on, we will see some pickup. We may do about 100 crores a month kind of run rate on the ETB base, but it has started seeing pickup.
Sure. So it will be ranging in a range of 15-20% is what we can see ahead?
In terms of growth?
Yeah.
Full year, we are still looking at a growth. We ended the last year at about 1,700 something. We think we will get it to 2,300, 2,400.
Sure. Thank you so much. Thanks. That's it from my side. Thanks.
Thank you. We have next question from the line of Vipin Kumar Jain with Apar Capital. Please go ahead.
Thank you, sir, for giving the opportunity. My question, I need clarification little. When most of the banks are saying that there will be treasury loss because of the rising yield. So how this federal bank is able to come with the profit? That is my question, sir.
Maybe you didn't get what Ashutosh explained. I would request you to connect with Ashutosh offline. He'll explain it to you maybe in a little more elaborate fashion.
In short, I can say there has not been much of a profit booking on treasury because that opportunity was not there as the interest rates had moved up. But what was there was prevention of loss and all. So the book was very slim, thin, and therefore the provisioning requirement was less. And that provision lies against other income. So I just wanted to clarify that because somebody was saying breakup of 167, 150 is loan loss provision and 18 is 17.5, 18 is about standard assets. Yes, only NPI provision goes there and there was no NPI there. And the rest of it, the mark-to-market thing goes against other income, above the line.
But there is separate head now for treasury investment income?
It's there. Interest is there, separately given. Interest income on investments, which is a separate line, which is 629 crores for this quarter. And there is other income. In that you have the mark-to-market depreciation, which is required. But because the book was quite slim, the amount also has been quite less. As against some banks who would be carrying larger books, if you carry larger book, you will have a larger hit.
Okay, thank you.
Operator, we should start beginning to wind down. Maybe 2 questions more and close out.
Thank you, sir. We have the next question from the line of Sameer Bhise with JM Financial. Please go ahead.
Yeah, hi. Congrats on a good quarter. Just one question. The sequential drop in tier 1 is primarily got to do with operational risk requirements?
No, I mentioned 3 things, right? Credit growth, the risk weights related to that. In that credit growth, some growth coming from corporates who have borrowings greater than 10,000 crores, so there's a higher risk weight on that. And growth in unsecured credit, where the line of credit is established, then the risk weight is on the full line. So these are drivers. In addition, operations risk is not significant.
Okay. And just to reiterate, did you say that for potentially 18-20% of the retail restructured book may be, you've considered that it could potentially slip in the 1,800 crore guidance?
Ladies and gentlemen, kindly stay connected. We lost the line of the management. We'll be connecting back soon. Please stay connected. Thank you for patiently holding, ladies and gentlemen. We have the management line back in the conference. Sir, you may please proceed. Mr. Vise, you may please repeat your question. Thank you.
Hi. So just to reiterate, you said that the slippage expectation, which probably will remain similar to last year's level, probably includes around 18-20% of the retail restructured book, which probably could slip. Is that a fair assessment?
Yeah, I said the overall slippages guidance for the full year is around 1,800 and plus minus a few basis points. Few points will be all inclusive.
Okay. Thank you and all the best.
Thank you.
Thank you. We take the last question from the line of Anusha Raheja with Dalal and Broacha. Please go ahead.
Yeah, congratulations, sir, for good set of numbers. I just want to ask, what is the share of non-retail deposits in your total deposit book?
92% is retail, Nisha.
Okay. And I just missed on to that, 48% you said is EBLR linked loans and 26% is the fixed part, right?
Yes.
And 28% is MCLR?
Yes.
Is that what you said?
Yeah, more or less.
So what is the percentage, for the current fiscal you feel that, would get repriced at higher rates?
So the floating rate book, which is, if you take EBLR plus MCLR as floating rate, at different points in time in the financial year, you get repriced.
Well, some part of the fixed part, might be probably, later part of the year,
Depends maturity.
Depends on the maturity, yes. Okay, so largely, closer to around 70%, or you seeing that would get repriced at a higher rate?
Yes.
And I just missed on to that. What is the full year credit cost guidance that you've been giving?
Roughly about 50 basis points.
50 basis points. And there is no capital raising plan in the near future?
At this juncture, we are not looking at anything.
But the board approval has come in, right?
We have taken board approval, as we did last year also. We are going to the shareholders. The AGM is on 27th. Hopefully, we will get the shareholder support. It's an enabling resolution, allows us 12 months till we go to the next AGM if there's an opportunity for us to raise. But we took it last year and the...
Yeah, sorry.
Yeah, no, I said we took similar approval last year and the previous year, but we're quite judicious in the use of capital.
Last year we did our Tier 2 bonds, 700 crores, that's all.
But if I just look at the Tier 1 capital, you're comfortably placed at 14% plus, I guess.
Yes, at this juncture, yes.
Okay, just one last thing on this, how is pricing of the FCNR deposits, being done currently?
We have just taken up our FCNR rates to a very competitive rate. 1 year dollar is 350.
Okay.
It is commensurate to how the U.S. Treasury yields are moving. So, and plus competition, what is the competition quoting? So all these factors are taken into consideration, deliberated at ELCO and college second. Right now, what Shyam has said, that is the number.
So don't you think this can impact your margins negatively? Because,
dollar deposits, if you have dollar lending opportunities, it won't. Second, there's no CRR, SLR on this.
Okay.
CRR.
Yes. Okay, thank you, sir.
Thank you very much. You can bring it to a close.
Thank you very much, sir. Ladies and gentlemen, that was the last question. I'd now like to hand the conference over to Mr. Souvik Roy for closing comments. Over to you, sir.
Hi, thank you, and thanks to Shyam sir for welcoming me into my new role, and thanks to everyone for joining the call. See you on the other side of Q2, and hope to see you with a better set of numbers. So, best wishes and a great weekend ahead. Thank you, everyone.
Thank you very much, sir. Ladies and gentlemen, on behalf of the Federal Bank Limited, that concludes this conference call. Thank you for joining with us, and you may now disconnect your lines.
Thank you. Bye-bye, everybody. Thank you.